Hey, how's it going, guys? What if I tell you, even though the S&P index gives you the positive return, you're still losing 30% of your investment every single year? What if I tell you the passive income you collect from your dividend stocks actually worth way much less than it shows on the paper? These are exactly what will happen to us when the inflation crisis hits our economy. On February 20th this year, the Big Short legendary hedge fund manager Michael Burry officially sent out to all of us a strong warning signal. The US government is doing whatever possible to invite inflation into our economy. And if things get out of control, which Michael Burry strongly believes so, a hyperinflation crisis will come and wipe out a lot of investors' life savings. But there's a good news. Inflation can also provide us with some of the best investment opportunities to make great amounts of profits if we position our portfolio correctly. So in this video, I will show you guys how exactly you can adjust your portfolio and what are the best group of stocks you can buy when inflation comes. Alright, let's get started. Before we jump into the stocks, let's take a look at the macroeconomy and understand why the market believes an inflation crisis is coming. In general, there are two major factors that can cause an inflation crisis. First, the sudden excessive money supply. Second, the extreme supply and demand imbalance. And very unfortunately, right now, because of the COVID-19 shutting down the entire economy, we're looking at both of the factors are playing out. Let me explain. The first factor is more obvious and easier to understand. Over the past 12 months, from March 2020 to March 2021, the US government has announced they will have to print in total close to $5 trillion to stimulate the economy. This is more than twice of the total money supply in the entire US history combined. And they won't stop there until they believe the economy is fully recovered. This is why we're seeing some of the investors like the Big Short legend Michael Burry publicly sending the warning signals and saying the US government is basically inviting inflation crisis to come. The second factor is a little less obvious but not difficult to understand at all. This COVID-19 pandemic has completely disrupted both supply and demand in our economy. On the supply side, we're suffering one of the biggest supply shocks in the entire history due to the global lockdowns. The cost of the supply chains and the delivery services are both skyrocketing much higher due to the pandemic. On the demand side, people are saving more money than ever before. It's not because they suddenly want to save money. The truth behind this historically high savings rate is that they're getting stimulus checks every single month, just sitting at home and have nowhere to spend those money except betting on the stock market. In economics, we call it the pent-up demand. One thing you should know about the pent-up demand is that once the economy reopens, we will see a rapid outflow from those savings into the real economic spendings. And guys, that would create an extreme imbalance between the supply side and the demand side as the economy reopens. So the unlimited money supply plus the extreme supply and demand imbalance is creating a perfect storm for an inflation crisis. This is why we're seeing the bond market, also known as the smart money market, is rushing to price in this coming inflation crisis. As investors, especially those who are new to the financial market, you should understand how dangerous it can get when the inflation gets out of control. Alright, the next important thing we need to understand about making money in the middle of an inflation crisis is the key relationship between inflation rate and the interest rate. And to understand this, we need to invite our old friend, the Federal Reserve. You might think the Fed has a lot of jobs to do to maintain our economy, but essentially, they only have two jobs. First, maintain the economic expansion. They do it by making sure the employment rate is close to zero. Second, maintain the overall prices of goods and services stable. They do it by making sure the inflation rate is between 0 to 2% every single year. How do they do it? Printing money is one of their two major weapons, and the other one is manipulating the interest rate. To be more precise here, this interest rate they manipulate is the overnight lending rate between those commercial banks within the US. This is the interest rate that those commercial banks charge each other to borrow money for the short term. Some people also call it the federal funds rate. This federal funds rate has a direct impact on how expensive each bank can operate in our banking system. We can understand this interest rate as the baseline interest rate of our entire financial system. The higher this baseline interest rate goes, the more expensive those commercial banks' operations will be. And as a result, those banks have to increase their own interest rate for our mortgages, credit cards, car loans, and business loans to cover their own increasing interest expenses. This is why whenever we hear the Federal Reserve is planning to raise the interest rate, the stock market always goes down. Because every credit will be more expensive in our market. And our stock market is primarily driven by credit. Alright, why this interest rate controlled by the Federal Reserve matters so much to the inflation rate? Well, simply put, when the inflation rate is heating up, the Fed will have to raise the interest rate and make borrowing more expensive. On the other hand, when the inflation rate is too low or even goes negative into a deflation, the Fed will have to cut interest rate and make borrowing more affordable. There's one key thing I want to highlight here is that raising or cutting interest rate is not a 100% guaranteed way to fully control the inflation rate, because we still need to consider the impact of the money supply. However, there's one thing that is 100% guaranteed is that the changes of the relationship between inflation rate and interest rate will have a significant impact on the different sectors in our stock market. Alright, now I will show you guys what are the best stocks to buy when the inflation crisis hits. This is probably the most important chart in this video. On the x-axis, we have the correlation between the equity returns and the rising or falling interest rate controlled by the Federal Reserve. On the y-axis, we have the correlation between the equity returns and the rising or falling inflation. So with this x and the y-axis, we can separate the US equity market into 4 different quadrants. And in each quadrant, there will be some certain sectors and industries that can significantly outperform the rest based on the changes of inflation rate and interest rate. For example, when both inflation and interest rate are falling, this is a great environment for growth tech stocks with high leverage or consumer staple stocks and utility stocks. In other words, these are the worst stocks to buy when the inflation crisis comes. When the interest rate is rising but the inflation is falling, such market environment will benefit the semiconductors and the healthcare companies. And when inflation is rising but the interest rate is falling, real estate, retails, materials, and value tech stocks will do very well, especially the real estate stocks, where investors can actually benefit from both rising inflation and the cheaper mortgages due to the low interest rate. But the quadrant I really want to highlight is when inflation is rising, also at the same time, the Federal Reserve is trying to raise the interest rate. This is the market environment when the inflation crisis can hit really bad and destroy a lot of people's savings if the Federal Reserve fails to get things under control. But the good news is, in this what I call the inflation crisis quadrant, there are some stocks can do extremely well. The best stocks to buy are the banks and commodity producers. They can benefit from both the rising interest rate and the rising inflation. Also, the insurance companies, the energy companies, and the gold miners will also do extremely well in this environment. So this is where your money should flow into before the inflation gets out of control. That is exactly why over the past 2 weeks, we're witnessing one of the largest capital flow from the high-growth tech stocks and defensive utility stocks into financials, energies, and commodities. The market is already in the race of pricing in the coming inevitable inflation crisis. Cool, so in summary, here are the key takeaways. First, the best stocks to buy for inflation are the financial stocks and energy stocks. While on the other hand, the worst stocks to buy when inflation crisis comes are the utility stocks and consumer staples. Basically, these are the companies that have a very tight profit margins. Any increase in price and services will significantly push down their profitabilities. Next, if the Federal Reserve starts to raise interest rate, then the best stocks to buy are the financial stocks. And the worst stocks you should stay away from when the interest rates are rising are those heavily leveraged in-debt tech companies and as well as the real estate stocks, which are very sensitive to high interest rate. Alright, I hope this video helps you guys have a better understanding on how you should invest in the stock market and how you can protect your money before the inflation crisis hits. Of course, the stock market is not only placed to hedge against the inflation. There are many other ways, like for example, directly buying commodities, buying physical gold, or even cryptocurrencies like Bitcoin could be also extremely effective to profit from the rising inflation. Alright, that will be the end of this video. If you are new to this channel, my name is Vic. I make videos every week to share some of my thoughts on what is going on in the financial market. And I also share some educational contents to help your investing journey just like this one. If you are interested in the world of finance, the business, and find my videos being valuable to you, please consider subscribing. Again, thanks so much for watching guys, and I will see you guys soon.